In this video, I'm going to explain why do stock markets exist, what is their purpose, and how you can benefit from the stock market. So if you really want to understand, I request you to watch this video till the very end. So today we are going to discuss why do stock markets exist. But before we get to that stage, we first need to understand what economics is and how an economic perspective on society leads to the creation of markets, and hence then we move on to the stage of stock markets, right? So economics is basically the study of utilization of scarce resources in a society, you know. So all of us humans, we are on this planet earth which has limited resources, right? And all humans, me and you, we have needs, right? We want food to eat, and we don't just want one food, we want a variety of dishes to eat. We need a home to cover ourselves, we need clothes, right? We need furnitures, we need computers, we need a toothpaste. So like we have so many different needs for so many different aspects of our lives, right? Now if you look at human civilization from a primitive early historical perspective, when you know we were still, let's say, in the jungle hunting for food, or we were in the farms, most of us were in the farms, farming for crops. So there's only a limited number of things that I as a person can do, right? Either I can farm for a particular set of crops, but then that's all we have, we just have crops. Who is going to make our homes, right? If I cut wood and make furniture and homes out of that wood, then who is going to grow the crops, right? So there are different needs, and one person cannot attend to creating all the needs. One person cannot attend to gathering resources and working on them to basically fulfill all the needs, right? So from there comes the concept of specialization and division of labor, something which is highly discussed in the book The Wealth of Nations by Adam Smith. So now what specialization means, what division of labor means basically, is that a specific set of people will do a specific set of tasks, and another group of people will do another set of tasks. And so 20 different groups of people will do 20 different kind of tasks to prepare 20 different kind of comfort and 20 different kind of essential, and to attend to different kind of essential needs of human beings. So for example, if somebody is doing farming, so somebody is growing rice, somebody is growing wheat, somebody is growing potatoes, somebody is growing brinjals. So then you have different variety of farmers growing different variety of stuff. So you're getting on your table, you're getting biryani, you're getting you're getting paratha. So different ingredients. Now you want furniture, so somebody is cutting wood, somebody is making that wood into furniture, somebody's doing that. You want fuel to run your car, so somebody is doing the work of getting the oil from this from the resources, right, and converting that crude petroleum oil into diesel, and other usable fuels. I want to wear clothes, so somebody has to grow cotton, and someone has to basically process cotton into fabric, and then that fabric gets converted to the clothes you wear. So this is where the concept of markets come into picture, because there is specialization, because there's division of labor, and it's essential to have division of labor and specialization, because otherwise you cannot survive, otherwise you will not have the sources, the resources, and the comforts of life, right? So this is important. And now once there is a division of labor, once there is specialization, therein comes the concept of market. So if I'm a farmer, then I'll sell you my produce, I'll sell you my wheat, but in return I want something that I don't produce. I might want a furniture, I might want a computer, I might want a toothpaste, I might want clothes. So you're going to give me what you produce in return to what I produce, and that's how barter started. And then, because barter is dependent on double coincidence of wants, so then we slowly moved on from barter to other primitive forms of money. And then it's a long story, but now we have money, the modern form of money. and there are markets, so because there's division of labor, and you're specialized in doing something, your friend is specialized in doing something else, your neighbor is specialized in doing something else, so they're each selling their service or their product, and therefore we have a market society. Everyone is producing something, and then they're exchanging it for things that they don't have. So this is the concept of market. And when you want something, that is called demand. And when you give your produce to other people, that's called supply. So demand and supply, these are the two fundamental forces that drive the market. And if there's more demand for something, it's going to cost more. And if there's more supply of something, it's going to cost less. So that is how markets operate. So this is by explaining this, basically I wanted to set a background of why do markets exist in the first place. Now let's enter the 21st century. Let's enter the even like the stock market is way more than 100 years old. So once we kind of went past through the agricultural revolution, we entered this industrial phase of mass production. So now the companies need to get a lot bigger, and the opportunities in the market are immense, because there's liberalization of markets, deregulation of markets. So you are in India, you are in Afghanistan, you're in America, and you have started a business, and you can expand your business worldwide. So now the entire world is your market, basically. But to expand, okay, so now let me explain where do stock markets come from. So let's say you started a business of a grocery store, right? And it's a small grocery store down your lane in your neighborhood. You're selling eggs, you're selling milk, you're selling all the grocery items over there, and people really like buying from you, right? People really like buying from you. So you know you get a lot of customers, and you feel that if you expand your shop to other neighborhoods in the city, or maybe other cities in the country, or maybe other countries, you can really expand yourself. Then because people know that your brand and your service and your products are really fresh and really good quality, and you are an honest person to deal with. So because you feel that there's something in your business that's going to basically blow up, that's going to get people to you, then you really want to expand the business, right? And if you expand big enough, then it might really take your business to a completely different level. Let's say you earn 10 lakh rupees per annum today with your little grocery store, but if you can expand throughout the country, maybe that 10 lakh rupee annum will increase to 20 crore rupees per annum, or 50 crore rupees per annum, or something like that, right? So there's a huge potential, that the market is huge, the potential is huge, and you can do it. All you need is capital, right? Now there are two ways to go about taking capital, basically. Okay, there are two ways to do it. The first is taking a loan, taking on debt, right? But this is a bit risky, because if you default on your loan, then your entire business can be in jeopardy. Your entire business can shut down, because bank might take your entire business as a collateral, and it's never an intelligent decision to take a loan when odds are against you and not in your favor, because the risks are high. So the other form of financing your business and expanding your empire is by equity financing. So what is equity financing? Equity financing is basically you give a part of your business to other people, and they give you cash, they give you capital, they give you money in return for ownership in your business, right? And this is where the concept of stock markets come into picture. Now, between a small startup, between a small company and that company reaching the stage of an IPO, there are a lot of other steps and other stages that come into between, seed capital, venture capital, round one, round two, stage one, stage two, whatever you want to call it, and then ultimately it reaches the IPO. But essentially what happens is that whenever you want to grow, whenever you want to expand, you add more people as your partners. I mean, let's say you at the beginning, you own 100% of the company, right? But then what happens is that you want more money to expand. So you, let's say, give 5% of your company or 10-20% of your company, and you bring in cash, let's say 2 crores, 3 crores of rupees, and then you expand. But then you want to expand to even bigger level. So then you kind of give more of your equity, and then you bring in more capital, right? So that's what happens. And ultimately, a stage reaches where you think you can go really, really big. And that is when your company enters the stock market. That is when your company enters the stock market, basically. Okay, so before the stock market, let's say you have 100% of the business and you want to expand. So you might ask your friends, you might ask your family that, I want to expand my business, do you want to become a partner? They might agree, they might give you some money, you might give them 5%, 10% of equity, and that's it. But once you need like hundreds of crores of rupees to expand to a completely different level, right? So then, not one, not two, not three, not 10, 50%, even 100%, even like 200, 300 people are not going to be enough to finance your company, right? For that, you need hundreds and thousands of people. You need hundreds and thousands of people to basically buy into your idea of your company expanding and give you money, right? And that is where an IPO happen, an initial public offering happens. So what happens is that you take your company to an investment bank or to any financial institute that does an IPO, and what they do is they write a proposal for your company, right? They write a prospectus for your company, which is going public, and I'll explain what that means, right? And let's say your company, let's say it's Best Grocery, right? The name of your company is Best Grocery. And the Best Grocery is going public. It's going to the stock market where everybody can buy shares of Best Grocery, and they can buy and sell and trade Best Grocery shares, right? So then what they will do is they will, let's say you want to sell 60% of your company to the stock market, right? So they're going to come up with a valuation. They're going to come up with like, what is the value of your company, right? So let's say based on future prospects, they value your company at, let's say, 100 crore rupees, right? They value your company at 100 crore rupees, and you are selling 60%. So they will give you 60 crore rupees, and you can use that money to do exactly what you want to do, which is to expand your business throughout the country or maybe throughout the world, whatever your plan is, right? And that 60 crore will not just come to you, it will come to the business, and you will not own it, but all the partners that you had gathered up till this stage, they will collectively own that money. But it's mainly to get into the business. That money is there for the business to expand anyway. So they will buy 60% of your company. But who will buy? Like, when I say they will buy, what does it mean? Well, the investment bank is basically the primary market. They are the primary customer. So first, the investment bank will make sure that your company is fully subscribed. They'll make sure that your company is fully subscribed. What does that mean? Well, investment banks have connections with mutual funds. They have connection with hedge funds. They have connection with pension funds, and all these funds which buy stocks, which buy stocks because people are investing in those mutual funds and hedge funds and pension funds, right? So they will agree, okay, yeah, you can, we are ready to buy this new company called Best Grocery as part of our portfolio. Okay, and once that is ready, once enough people agree, okay, we are going to buy, then that will be and in fact, if there are people who want to buy, but you are like you let's say you want to sell 60% of the company, but there are people who are so eager to buy your company that 60% of your company is pledged. 60% of the company is already subscribed. There are already people saying that when you do the IPO, we'll buy it. But there are people even after 60% that say that we also want to buy the company, right? So that means your IPO will be oversubscribed, which is a good thing. I mean, it means there's a lot of demand. There's one way, that is, this subscription service is one way of doing it. And the second way of doing it is that investment bank buys the company themselves, which is a bit risky. But anyway, so these are the two ways of doing it. And remember, your company is still not on the stock market. It's still in the primary market. The first people, primary means the first people who have agreed to buy your company. And then these people, the primary people, the mutual fund, the hedge fund who agreed with the investment bank to buy your company, will then make it public on the stock exchange. And once they sell, like let's say you sell 60 crore rupees of the stocks, and one stock, let's say, is worth 500 rupees, or let's say one stock is worth 200 rupees. But when these primary buyers will sell the stock for the first time on the stock exchange, which is the IPO, the initial public offering, because that is the first time the public will get offer or to buy that stock, right? So they will not sell it for 200 or 500. They'll sell it for, let's say, 1200 or 1300, right? That's their profit. And then when they do that, when they first offer the stock on the stock market for a much higher price, 1200, 1300, whatever, then it will suddenly be available on the stock market and everyone will be able to buy it, you know? So this is how a company goes to the stock market, and this is why stock markets exist, because of the stock market you were able to generate so much of capital for your company, and that is why you are able to expand your company and do all sorts of amazing things which otherwise you would not have been able to do, right? And there are people now on stock markets, hundreds and thousands of people are going to buy your stock. Okay, maybe someone will buy just one stock, maybe someone will buy just 5 or 6 stocks, maybe someone will buy hundreds and thousands of stocks, depending on their budget. Some mutual funds will have your stock, some foreign investors will have your stock, some retail investors will have your stock, all kinds of people will have your stock. Now if your company does well, if your company does as you promised, then the value of those stocks will increase, and those investors who bought your stock on the stock market, they are going to profit, because the value of the share will go up, right? And if you don't do as well, then the value of the stock will go down and they will be in a loss. So this gains and loss and up and down of the price, that will just go on for eternity. And if you open stock market, or if you search stock market on Google, the most prominent thing you will see is that these charts with lines up and down. This is basically a price of the stock going up and down, right? So this is why stock markets exist. The stock markets exist because we are living in a market society. We're living in a society which needs specialization and which needs division of labor for the economy to function. And the stock markets exist so that you can fund your business, to take your business to the next level, right? And then this is like the theoretical understanding of it, and as well as practical understanding of it, right? And if things go well, then it's good for the person who did the IPO, because his business is going to do well. He personally is going to do well, and the investors who bought the stocks are also going to do well, right? Because they bought stocks of a good company which is doing well, so their investments will also do well. On the other hand, there are many scams as well, where people do IPO of companies who don't perform so well. I mean, they promise something, but they do something else. In that case, the company also goes bankrupt and the investors also lose money. So it's a game of caution. You have to, know which company you are investing into. You must do your research very well. You must study the fundamental financial statements of the company. You must do the research on who's the CEO of the company, how is the management, who's the founder of the company, what is the work culture over there, are they making any profits, what is the customer opinion of the company, are the clients happy with the company, all these kinds of stuff. Anyway, that's a completely different topic on how to invest in the stock market. So this video specifically focused on how to invest. This video specifically focused on why do stock markets exist. I hope I've given a plausible explanation. Thanks for watching, and I'll see you in the next video. Assalamu alaikum.